Hello everyone. So in today's lesson, we're going to learn about the chart basics. We're going to learn about candlestick structure. We're going to learn about uh, higher highs, higher lows, market trends. We're going to learn about uh, accumulation, manipulation, distribution, record structure, and market structure shift, and identifying valid support and resistance zone. So let's start with candlestick structure. So everything's candles is the start of everything in price action. Each candle shows what happened within a specific time frame. So if you check a 1 hour candle, you're checking what happened in a whole hour. If you check a 1 minute candle, you're checking what happened in the 1 minute chart. A candle has four key parts: open, where price started; close, where price ended. So high is the highest point price reached, and low is the lowest point price reached. So there are two types of candles: they're bullish candles and they're bearish candles. So let me explain. So a bullish candle is described by, say, let me mark this as, so this is a bullish candle. Has some weight away. So that's a bullish candle. In a bullish candle, this is the open. Sorry. This is the open. This is the open in a bullish candle, and this is the closed in a bullish candle. Okay, so this is the open, and this is the close. So price closes here. So if you see a bullish candle, this is the open, and this is the close. And these are known as wicks. What wicks generally means that price opened here, dipped below at some point, then came back into where it opened, went high until this is the ultimate high that was created when price moved high. And then after it created that high, it went back again and closed here. So this is the close. Same we can say for a bearish candle. So this is the bearish candle. These are wicks, and these are quick. So in a bearish candle, everything is in the opposite direction. This is the opening price of the bearish candle, and this is the closing price of the bearish candle. What this means, price opened at this point, went higher, and came back into where it opened, went low to this point, then it came back in and closed at this point. So that is open, close at the highest point, at the lowest point of the candles. Okay, let me show you in charts. This is a bearish candle. Okay, so this was the opening price of the bearish candle right there, and this is the closing price of the bearish candle. But when the price opened at this point, went high a bit, then came back in and went up to this lowest point, then came back in and closed at this point. That's what this means. Then we have this one. This is not an example. They involve a bullish candle. So the bullish candle, what this means is that price opened at this point, then price went to this high. After getting to this high, price rejected, came back. So this is the open, and this is the close. And this was the lowest point of the candle, and this was the highest point of the candle. Yeah, so that's all about the candlestick structure. But if you need more information, you can just comment on which part, and I will elaborate the structure further. So large bodies show momentum. See, large bodies show momentum. So like right now, there was this large body here. This shows like the bullish momentum has come in. So that's why we're seeing price pushing a bit higher. Then we have long wicks. See, long wicks. This all long wicks are often liquidity hunt. You can see here, this long wick was a liquidity hunt for this. And this long wick here was a liquidity hunt for this. Okay. So we'll get more into liquidity later, but that's generally what we'll be looking for. And market structure. So let's learn about market structure. So under market structure, the market only moves in three directions. The market can either move in an uptrend, downtrend, or sideways movement. So prices moved high, low, high, lower, high. So this is what is defined as an uptrend. And at this point where price has broken through, now that's called a break of structure. This right here is a break of structure. And again, this right here is another break of structure. That is a break of structure. That is a break of structure. Now, at this point, this is a lower high. Okay. And this is another lower high. And this is another lower high. Okay. So let me start over about that. Yes, sorry. Let's start here. So when prices move this way, this means price is creating higher highs and higher lows. That means price is in an uptrend. You see here, price broke this high. Well, that's a break of structure. Price went again and broke that high. That's another break of structure. Price went again and broke that high. That's another break of structure. A price goes and breaks that high. That's a break of structure. Look here is where we have our break of structure. This is another break of structure. This is another break of structure. And this is another break of structure. And now price moves in higher highs and higher lows if price is in an uptrend. So as you can see, this is an uptrend. Price is making higher highs and higher lows. Let's mark the higher highs. This is the higher high. This is another higher high and another higher high and another higher high. This is a higher low. This is a higher low, another higher low, another higher low, and another higher low. What this means is that the low that was created is higher than the lower that was previously created. That's why it's called a higher low. So this is the general structure of an uptrend. And then you have a downtrend. So a downtrend is now the inverse of an uptrend. So a downtrend is characterized by price making lower lows and lower highs. Okay. So in a downtrending market, now this is the break of structure. This right here is the break of structure. When price breaks the low that was created, now that becomes our break of structure. So break of structure. Now that's another break of structure and another break of structure right there. And when price is downtrending, means it's creating lower lows and lower highs. Now this is our lower high. And another lower high and another lower high. And as it creates lower high, it also creates lower lows. So that's a lower low, that's a lower low, that's a lower low. What this means is that price is creating a low that is lower than the previous one. And here, price is creating a high that is lower than the previous one. So that's not why it's called a lower high and a lower low. So that's all about the types of structures. And the other type of structure that I was going to talk about is the ranging or sideways movement. This is where price is moving in sort of in a consolidation type of way. Price does not want to break a specific high up here, and also price does not want to break a specific low down here. So that's why we say price is ranging. Now that this is a ranging market, and we avoid ranging markets, we want to see trending market. Okay. So we've seen the market structure, we've seen higher highs and higher lows and lower highs. We've seen the uptrend, downtrend, and the ranging markets. Okay, I'm going to skip this for now because we're going to learn it later under liquidity. So the last thing we're going to learn today is the breakout structure and market structure shift, and identifying valid support and resistance areas. We've already seen about the breakout structure. So let's now look at a market structure shift. So what a market structure shift is, when price is uptrending, what shows us that price might be changing direction so that we can move to the other area. This often happens when there's a liquidity hunt. After the liquidity hunt, there might be a market structure shift so that price changes date of delivery from an uptrend to a downtrend. So let me show you an example of an uptrend that changes structure to a downtrending market. Okay, so here, price was clearly making higher highs and higher lows. But when price comes down and drops below the previous higher low, right here, and comes back into the range, is where we're looking for entries so that we can take the price low. So what this means is that if price breaks the previously noted higher low right there, that means the price has changed its state of delivery from an uptrend, and now we're looking to be downtrending. Now, this is what is known as a market structure shift. And when you see the market structure shift, now we are looking for a retracement into the range so that we can take the trade lower. Okay? So this will now be a breakout structure to the downside, and another breakout structure, and another breakout structure to the downside right there. So price was in an uptrend, gave us our market structure shift. And so that to change now to indicate to us that price might no longer be making higher highs and higher lows to go higher. Price now wants to sell. And this is equally opposite when price is downtrending. Now when price downtrends and reaches a certain point, it does that. Okay. So now this was a higher low. Now when price breaks the previous higher low, this was another higher low and another higher low. When now price breaks this higher low, is what we refer to as our market structure shift. Now price is no longer downtrending, and this means price will no longer be downtrend. Price will start going higher. So we have a higher low, breakout structure, then our market structure shift, then our retracement into this, then we go higher. I forgot to mention about the retracement. So if we have a breakout structure, like right here, this is our breakout structure. When price comes down, that means price is correcting before it continues going higher. So this is what we is known as a correction or a retracement. So this is another correction. This is another correction. Okay, but we referring it as retracement. So market structure shift, retracement, price goes lower. Retracement, price goes lower. Retracement, price goes lower. Then what does price do? turns and take out the higher lows. So that means we're no longer looking for sells. We're now looking for buys. Retracement, price goes higher. Retracement, price goes higher. Retracement, price goes higher. So that's all about retracement and correction. So yeah. So once we've known about that, we now be looking at liquidity. Then I cover the support and resistance, identify valid and support resistance areas so that we can finish there. So liquidity rests in highs and lows in the market. That's why liquidity is resting. So in an uptrending market, yeah, it creates lows, right, and highs. So so in an uptrend, we're trying to identify liquidity in an uptrending market. This high that was created here, that was liquidity. And when price moved up to take it out at this particular point, to create another break of structure, now that was liquidity sweep. The liquidity was swept there. And right now, we have liquidity in two areas. Liquidity is resting there, and liquidity is resting there. So liquidity rests between highs and lows. Okay? Then what price again came and did was price swept that liquidity. So liquidity is where we are targeting our areas. Okay, so price retraced again into the range. Once price retraces into the range, we're now looking for the next liquidity area that we can target with the next liquidity area. Yeah. And what did this low create? This low created another liquidity level. Okay, so price comes again and sweeps that liquidity. Now we know that this market will be uptrending, and when it's uptrending, we target the highs. The highs, that's where liquidity rests. And the same is equally opposite to a downtrending market. So we are downtrending, prices at that point. So here we have liquidity resting here, and we have liquidity resting there. So what we want to do is see price come again lower to sweep this liquidity level, then comes retraces back into this range from here to here, right there, then now drop again. And once it drops again, it means price has gone and cleared this liquidity level, and now also generated this liquidity level right here and this liquidity level right here. So when do we actually target these liquidity levels? Up here. So when price is downtrending, when it gives us our market structure shift right there and comes back into the range, now our targets will be this. Our target will be this liquidity. This liquidity is a valid liquidity area. This is another valid liquidity area, and this is another valid liquidity area. If you want to be aggressive, you target all the liquidity areas. If you want to be conservative and you're learning about trading, it's better to target on the nearest liquidity area until you develop the skill and the endurance to hold your trades. So we'll be looking for trades to go until it clears the highest liquidity level. Okay. So that's all about liquidity areas. So the next thing is identifying valid support and resistance zone. So if price came and broke that high, if you look at this point, price came here and bounced once and twice. Okay. So if now the price changes its delivery and starts downtrending, well, we know that people who trade support and resistance areas always put their entries at support and resistance areas. Okay. So support and resistance area is where we target our price to go. That's one way of targeting out where our prices go. So here, price comes up and we take it to the resistance zone, the support zone that was created. So support is below and resistance is above. So we can say this is a resistance zone, and this is a support zone right here, and this is another support zone here. And so if price comes here, there's a support zone, this is a resistance zone. Okay, so we don't need to learn more about support and resistance zones because you're just going to be targeting support and resistance zones. So I'm going to be explaining why we took these trades. Okay, we have not learned about the order block yet, but we've learned about structure, right? So if you see at this point, price is making lower lows and low highs. As we talked about, price moves high, low. Okay, price came here, made our low, price made our high, a low, our high, our low, and another high that failed to break this previous high, our low. And once price broke this place, we're now looking to sell. See, our market structure shift happened at this point. Now we're looking to sell. Price came down, price corrected, and price broke structure again right here. So once price broke structure, we were waiting for the retracement, and price came into the retracement right here. So once price came into retracement, clearly price came into the retracement. That's a higher time frame bias. So now we want to keep selling this position. So we go to our 1 minute time frame. And our 1 minute time frame, we're looking for a market structure shift. Our market structure shift took place there. And now we'll be looking at the 50% level of the Fibonacci. Right here, we have our high and we have our low. Now when price taps into our 50%, we set once price breaks through here, we set our limit orders at the 50% of the old price move, and we target liquidity areas. Now, this was a valid liquidity area. This was another valid liquidity area. So that's where we target our price to go. And if you go slightly back, you see this, we have another valid liquidity area here. We have another valid liquidity area here because of the lows that were created. And what's here? This is a support that was support and resistance at the same time. We see we have one bounce from here, another bounce here, and another bounce here. So if we mark this point, this is a valid support and resistance area. So that is ultimately where I wanted price to go because this was the valid support and resistance areas. But once price gave us the 1 to 5 risk reward trade, we were out of the trade completely. So that's why we target the support and resistance area, because that's where price wants to go, because that's where retail traders are waiting to take their orders. So we learned about the breakout structure, market structure shifts, higher highs, higher lows. So the next one, we're going to be learning about fair value gap and fair value gap and order block. That's going to be taking the whole next lesson, because the fair value gaps and the order blocks are the ultimate thing that we're going to be trading. And after that, we're going to be piecing all this information together to show you the strategy that work. Okay. I'm going to be showing you 2 strategies that work, and they're really powerful strategies, and that will make you profitable. Okay. And in this particular trades, we were assisted by our, if you don't want to like struggle into getting to know the support and not support, but the valid order blocks, valid liquidity areas, valid support and resistance areas. Now that's why we created our indicator. So for those who don't want to get into the technical side of this, there is an indicator that was created by our team, and that's what we use in trading. So as you can, I'm going to I'm going to show you why also we not only had these trades, but something extra told us they're going to be the trade. The trade is going to be there. So you don't need to stay in the charts for too long. You just need to wait and until it tells you, okay, there's a valid liquidity sweep. So let's get into the market and find the entry. So let me show you. So here we have the indicator. So this was the first trade right here. It told us we might be selling, so come into the market. And this was another time it told us come into the market, we might be selling at a valid area that price might reject from. This indicator follows SMC concepts. And once you see it print and it's downtrending, now that's when we take our entries. Again, it comes and tells us this is the third point. It tells us, okay, maybe we might be selling. So get in the market and find your entries. And as you can see, the indicator told us that we can hold this trade until this low. But once we were satisfied with our 1 to 5 risk reward trade, we're already out of the market. So you have to learn how to process if you get the right amount of money and the price gets to be your point, you have to get out of the trade, even if your trading rules are met. You don't want to hold trades for long, and you want to stay profitable in the long run. So that's all about today's lesson. And into the next lesson, we're going to be learning about order blocks and fair value gap. And after that, we're going to have the last lecture, which will be on piecing out everything to form one powerful strategy. So if you have any questions, comment down below and I'll address the questions and create a video specifically to address the question. So until then, happy trading.